So we're absolutely delighted to have Keith Smith here with us today. He brings over 20 years of valuation experience to the Bonhoeffer fund as its portfolio manager. In addition to managing the fund's portfolio, he serves as a director for Enterprise Diversified and as an advisor to Willow Oak Asset Management, the fund's general partner. He has also held positions with Empire Valuation Consultants, PwC Management Consulting and Research, and served as a captain in the US Air Force. He received an MBA from UCLA and a bachelor's in electrical engineering from Union College. Thank you for joining us today, Keith.
Yeah, thanks for inviting me. It should be a very interesting presentation. I'm just going to throw the presentation up here now so we can see, so everybody can see it.
Yes, sounds great.
So let's see. So what I'm going to be talking about today is an interesting topic, I think. It's primarily serial growth and operational leverage and looking at investments. I think it's a very important theme that a lot of people can really apply across different markets. And so what I'm going to do is first talk a little bit about some of the theoretical frameworks and what some other people have done in regards of putting together this and documenting this framework. And then I'm going to go through a specific example, a detailed example of sort of how you can use this to invest and what are some interesting ways of being able to use this particular framework. Okay, so this is sort of a disclaimer. None of this is for entertainment purposes only. None of this is investment advice, etc. And so we're going to start out overall in terms of one of the things that investors try to really look for overall is high return on capital businesses. And this is sort of where I sort of started out. And there's really two drivers behind high return on capital businesses. First is high cash flow return on sales, which are higher margins, growth in cash flows over time. And the second one are modest investment outlays. And you find modest investment outlays in really two sources. The first one is service businesses, where you're not investing a lot in capital. And the second one is leveraging off of other people's infrastructure. So for example, a company like Facebook, where in essence, the network's already built in and you're leveraging off, the telecom provider's service to basically generate profits from that perspective. So the first piece we're going to go towards is we're going to talk a little bit about the high return on sales aspects of it. And so if we dive into that a little bit further, there's two drivers in terms of the high return on sales. The first one is finding places where you can get higher revenue. And there's three sources of higher revenue. One is increased market demand. Second one is increased market share. The third one is increased product turns or velocity. So a company can generate revenues by the overall demand of the market being higher. They can get a higher share, but then in addition to that, them turning the products faster over time. Second aspect of cash flow growth is higher margins. And the key concept here is having a fixed cost to spread across more sales. And so that gives you both economies of scale, which are sort of the traditional ideas you think about, then economies of scope, which are basically additional products that you can sell to existing customers. So that can create those are the types of the opportunities that we primarily focus on to try to take advantage. And then the final one is these economies of turns, which is being able to turn the product quicker. Therefore, you can generate the same ROE with lower margins, or alternatively, if you've got the same margins, you get a higher ROE for every one of the turns that you do. So the next one, let's see. Okay. So and one area I'm going to focus specifically on here is velocity, because it may not be as familiar with folks in terms of specifically what we mean by that. It's a multiplicative growth factor. Again, it's sort of, we described it previously, you sell more products to customers per year than your competitors, you can spread the fixed costs, you could offer more savings. This sometimes is also called, shared economies. So in essence, the company can generate more revenue and share some of that economies of velocity or sales with the customers. Therefore, everyone ends up better because in essence, the customer gets a lower price, the company gets a higher ROE, and that sharing aspect of it creates some interesting dynamics of companies. And it can become sustainable to the extent that you can retain existing customers and attract new customers. Now, velocity is also important just in terms of the way it can be measured. So there's one way you can do it, with products is sort of like inventory turns in products. And we're going to go through an example with Asbury today. We can see they have high inventory turns. And so that's one way to sort of measure velocity. The other one is recurring revenue or renewal rates if you're talking about a product like software or other types of products. So that gives you an idea of, okay, these customers are continuing to come back, and the velocity is sort of an aspect of them basically being able to do that. And now, the other aspect of this is we're going to be talking about the velocity and generating returns in fragmented markets. And the reason why fragmented markets are important is that's where you could actually generate better economies of scale by consolidating these fragmented markets. And so what you're really doing is you're finding businesses that have long runways and companies that over time basically can be consolidated, and they get these economies of scale primarily in local markets over time. So for example, if you have, let's say, like an auto dealership, and they basically buy another auto dealership in their same geographic footprint, there's economies of scale, for example, for local advertising and also management. And so those are examples of why it's an interest in looking at fragmented markets. It's a very interesting marketplace to do that. What's actually happened over time, though, is these markets have become fragmented, and then they can really become consolidated. So it's sort of like a cycle that just goes on and on and on. So for example, innovation creates fragmentation. And in the retail sense, it's created fragmentation between online, offline, and omni-channel. So if we take a look at car dealerships, so you've got, okay, you have the traditional online, traditional offline, and then what's happened is the internet's come in, created a disruption, and then you have some online only guys, you've got omni-channel guys, so the market continues to get fragmented, and then it becomes consolidated again. And again, one of the key things that I think is interesting about consolidation is you can get growth in revenue and in profits of business and consolidation without the underlying market growing, which I think is a very important point, because if you're dealing in mature markets like the United States, it's difficult to find, reasonably priced securities in markets that are basically sort of not growing a whole lot. But this is one way that companies can do it. And you can see this through time in terms of just looking at the charts of these companies as they go up and to the right, in terms of like auto dealers as an example, but there's a lot of other types of businesses that are like that. And we'll sort of see that right here. So one of the questions you need to ask is, where in the consolidation life cycle is the market? And the opportunities that we're looking for is very early. Now, if you get into a place where the consolidation has pretty much already occurred, and let's say there's 2 or 3 major competitors, there's not a whole lot more you can really get from consolidation. Then it becomes more of an efficiency play. So our sweet spot is trying to find markets that are very large, that have a lot of consolidation potential going forward. And this particular concept can be expressed across markets and across specific company markets and geographies. So what's very interesting about this is that within each country, for example, auto dealerships, each country has its own sort of auto dealer market that's consolidating. So if you look at it from that perspective, there's a lot of opportunities out there. So here's some examples of fragmented markets when I'm describing this. In equipment leasing, Ashtead and URI in the US is an example of that type of market, where basically they're rolling up smaller dealerships, and they're doing a combination of greenfield, going out and actually putting in new locations, but then rolling up existing locations. It's a very fragmented market. The top guys have maybe together 15% of the market. So you have a very large amount, a lot more consolidation. Same thing in automobile distribution. Automobile distribution is even more fragmented. I think the top guys have like maybe 1 or 2% of the market. So that's a huge market that can be. Another example of this could be IT services with CDW and Insight in the United States. And then connectivity, you can look at this, so you have consolidated communications and Frontier. So there's a lot of markets where these type of situations can happen, and you can get some real interesting opportunities. One thing to look at is you want to basically examine the incumbents. This is an interesting place where we found some investing opportunities, to look at the incumbents and see whether they can adopt the innovation. So for example, the internet in cars, in car dealerships. If you go back to that, okay, you've got your online only guys like Carvana, you've got CarMax, which has done sort of a combination too, but then you have some traditional dealers like Asbury, like we're going to be talking about later today, that have actually adopted the innovation. Now, where you can run into problems is if the existing incumbents, for whatever reason, cannot adopt the innovation or won't adopt the innovation. That's where you'll get large declines happening relatively quickly, like Kodak's an example of that, of them having the technology to go digital, but they decided not to. And when they finally did decide to do it, it was too late. So, but I think a lot of company managements have have really taken heed from those types of lessons. And most management teams today will try to adopt the innovation to the extent that they can. Okay, so this is an example. This is an overall a nice slide that the folks at Scott Management put together to get an idea of what are the different types of consolidating companies. So all over to the right, you've got roll-ups, which are primarily what I've sort of been focusing on. These are sort of, they're basically scale-driven synergies. And some examples are Waste Management, Berry Global, Johnson's, and automobile dealerships. This particular company, and there's a second set, platforms and accumulators. And what the difference is that in roll-ups, basically it's the same business. So the players in the market have an idea of what these businesses can generate. They have really good contacts to generate, deal flow in these types of business. Platforms are basically just clusters of companies that have a sort of a common thing, but they're not necessarily related. So what those companies are is, and there's a number of guys that have done this, and so they're real sort of shared synergies is more operational excellence since they're in different markets. There's an accumulator, which is similar to that. Guys like Constellation Software that do separate vertical software integrations, and those types of companies, there's more operational sort of independence, and those kind of companies can generate a lot of value from the independence of the operations. But as you're going to the right here, the platform and accumulators require a lot more specific skills and development of larger M&A staffs to deal with the diversity of the specific companies that they're actually investing in, versus like the roll-up. Primarily, if you've got a good existing management team, they don't have to spend a whole lot of time developing the expertise. So that's one of the difference between the two, but each of them have their pluses and minuses. If you look at from a relative valuation today, you can find some very, very reasonably priced roll-ups, in my opinion. The platforms and accumulators, they've been bid up, at least towards the end of last year. I think a number of them have come back down, but that's another interesting area to look for potential investment opportunities. In terms of, this is just another sort of snapshot in terms of ways to look at these kind of businesses, and they do a really nice job of saying, okay, here's what's the constraint on sort of the consolidation of these particular businesses? The first one, the TAM constraint. So in roll-ups, you're sort of stuck with a specific segment. That's why when I try to look for these companies, I try to find ones where there's a lot of opportunities. So you have, the TAM is, you're restricted to the TAM, but the TAM is gigantic compared to your size. And then for the other two ones, it's a lot less constrained because you're dealing with different segments and platforms and accumulators. So it's a little bit more wide open there, because in essence, you don't have, you're not constrained by just that. In terms of the resources, as we see here, you can see the resource constraint. The roll-ups are relatively straightforward, but as you go to the accumulators, those require very specialized resources. And companies like Constellation have done a really good job of building out sort of independent organizations to make that really happen. And so the guys, one guy at the Canuck Analyst Substack has put together a pretty good framework. I think I really like this in terms of getting an idea of, okay, when we're looking at these businesses, are they good businesses? Is this something you'd want to invest in? So one metric they use is return on invested capital plus half of the organic growth rate. As you can see on this chart, you're looking for stuff that's above the cost of capital, which is typically going to be like 10 to 15% is probably what it's typically going to be. As you can see on this chart, what you see is that as the companies get bigger, their returns go down, which is sort of what you expect. But this provides sort of a nice benchmark to say, okay, is consolidation really adding a lot of value compared to other businesses out there? And so this is just sort of a nice chart that the folks at a Canadian Analyst Substack have put together in regards to that. So now we're going to talk specifically about auto dealers. So the roll-up example is auto retail and service. So one thing that we look at is to differentiate the different players in this market is sort of relative velocity And one of the ways we can look at that in the car dealership space is inventory turns. What are the inventory turns? And if we look at the companies down here, you can see these are sort of like the current inventory turns. So, the highest one is CarMax, and then the next in terms of them and Carvana are sort of, they're the two sort of online guys. And then you've got in the traditional dealers, you've got Group One and Asbury that have decent, have the highest inventory turns. And then after that, you can look at margins, and those together will give you a sort of the return on equity. So it gives you an idea of roughly in these businesses how this works. So, Asbury has a combination of, I think, one of the higher inventory turns amongst the dealer groups, but then also has a lot of higher EBITDA margins in part due to their clustering strategy. So they focus on buying dealers within a certain geographic area. And that's where you're going to get most of the economies of scale in the auto dealer business. Getting a nationwide network doesn't get you a whole lot of scale, but if you get a bunch of real localized focused sort of groups or clusters of dealerships, that's where you're really going to see the economies of scale. And so in terms of the overall business, new and used car sales are really, in terms of a metric KPI to look at here, is basically this inventory turns metric. Service provides a majority of very high margin, and so that's another KPI to look at in the service business. The nice thing about this market is a very fragmented market. So the top 5 guys hold about roughly 8% of the business. So this is a market where I think there's going to be multiple winners. And so it's not going to be a winner take all market. It's huge. And there's a lot of runway for a lot of players to do well. So, and then, so one way to sort of take a look at this and incorporate this into your valuation process is to basically take a look at forward-looking valuation. And so one thing that we do with all of our investments is we come up with like a simple 5-year forecast, build up the revenue, take a look at sort of, and then when we're doing that, so we build up the revenue. So in this case, this is Asbury. So we're saying the revenue is going to grow. It looks like, we take analyst estimates, let's say for the next year. And then after that, we have more sort of steady state, which is based upon sort of the drivers of growth, which is they're going to get about same sort of sales growth of roughly 4%. They're going to acquisitions, which will grow about 10%. And then they're saying that internet's going to grow about 10%. Now you can also look at their competitor Lithia, who actually has higher revenue numbers in terms of growth, but you can also just take a look at what's happening with the company. Over the past year, they've basically gone from 0 to, I think, 15% of their new car sales being online within their market. So, I mean, I think that's really a positive trend for this particular company. And so the key thing, like saying, in terms of the growth drivers for revenue is you got organic growth, M&A growth, and then we can get to operational leverage, which you'll really see in the clustering strategy, that as the revenues increase, the profits are going to increase more because you have some fixed costs to spread across more units. And other things that companies have done, Asbury and other guys in this space, is you have debt pay down and buybacks, which are basically going to increase the returns to the equity. So one of the key things we do is we support key assumptions. You take a look at the history, and you take a look at sort of the growth of other suppliers and competitors in the market. And so I'll dive right now into sort of Asbury as an example of this particular framework. Right now, I think it's a great business model. It's comparable to others that have online players, but have significantly different valuations. So both CarMax has higher valuation, Carvana definitely does. The models are a little bit different. But the thing is, in my mind, is the valuation differences really more than make up for that. I think these guys are all, let's say, all going to relatively do well. The nice thing about the integrated players is you get revenue from multiple sources: new, used, service, finance, and parts, and online. A lot of the online players are focusing just on the used car, so they get used, plus they outsource the service contracts and finance and insurance, which is a big part of their aspect, but they don't have the new part or the service part, which in essence Asbury has. So basically the other aspect of the business is, if you're an integrated dealer, you have a larger number of customer interactions versus online. So let's say you buy a car from Carvana, you're gonna do it initially, but then the next time you're gonna have an interaction with them is probably when you buy another car. If you buy a car from, let's say, one of these existing dealerships, and you use their service, there's more opportunities for the dealerships to actually show their customer service acumen as a result of that. So there's more opportunities there. Now, some of the dealers aren't going to do that. It's actually going to be a negative, but the opportunity is there for dealers to show and provide better customer service through their service and their other areas that they're going to be providing. Asbury did add online only services in 2020. Here's basically where the gross profit is derived. Most of it's from service, as you can see, and smaller amount from used car and finance and insurance. The interesting thing about Asbury is the mix. They're luxury and import primarily, and in my mind, those are the better segments, or the segments where service, people will pay for service. If you're dealing with domestic mass market, people are looking probably more focused on price, and so you want to try and, at least for Asbury, one of their focuses is trying to say, okay, you're trying to find a segment of the market where you can provide service, but then you also want to be able to have your customers, the products that you're selling, basically to align with that. They have a low debt, and the average ROE has been 30% over 10 years. So it's clearly a good business from that perspective. Their approach to growth is sort of a quad play. So they pay down debt, they buy new dealerships, they're expanding the internet, and they're buying back shares. Now, depending upon what opportunities are available at the time, they'll do one or any of these particular items. So, for example, in the late teens time frame, they didn't find many dealerships were for sale, so they ended up buying back stock. So the nice thing about these businesses is they generate a lot of cash flow, and you can see how management's doing in terms of where they're going to be deploying the cash flow. That gives you a feel for, okay, what's the quality of the management team. Again, the one thing about Asbury is they do cluster. They have the highest margins despite the largest sales. So if you take a guy like AutoNation has more sales, it's bigger, but it doesn't have the higher margins because their dealerships are spread out. They're not clustered like Asbury's are. They have a large runway. Right now, they got 0.7 market share. And so the potential here is just really large for them to continue to pick up market share just from consolidation alone, let alone the other actions that they're doing, their other actions they're doing in terms of developing growth. They have the online service option, which basically is allowing them to sort of, they're adopting this technological innovation, and then by doing that, they're actually creating a nice path to growth going forward. And so generally, in terms of the auto dealership business, the key recurring revenue for automobiles historically has been service and aftermarket parts, because that's sort of the recurring revenue stream that happens after an auto is sold. What would happen is the demand for this kind of stuff is basically going to increase quite a bit associated with autonomy, because for autonomy, for pure autonomy, you need to calibrate every automobile that's on the road to make sure the sensors are calibrated correctly. So that's the one area where, as we transfer over to EVs, there may be less, let's say, mechanical work that needs to be done, but you're still going to have the sensor calibrations. And what they've actually seen in places where there's a lot of EVs, in Scandinavia, Bilia is a auto service firm over there. What they've noticed is that there isn't necessarily a decline in service. It's just different types of service that needs to be done for automobiles, because it's not like all of a sudden someone gets an EV and they're going to be an expert on how to fix their car. I mean, it's probably going to be the same people that fix their own cars when they're internal combustion try to do it when they're electric. So in essence, that service is still there. If you're providing, if you are a good customer service organization, I think you'll be able to maintain your service, your service aspect of that. The other aspect about going to EVs, though, is I think a lot of the service is going to be moving back from independent service guys to OEMs because of the complexity of dealing with sort of the electric vehicle versus sort of the internal combustion piece. The dealers provide service for warranty and sales, and they can, like saying, the dealers can be better equipped to service technologically evolving automobiles, which EVs clearly are going to be. So service demand right now is growing about 3% per year. I think that as they get more complex, they should be able to pull more service demand from independent guys as the automobile becomes more sort of complex from that perspective. If you just look at the business overall, the larger dealers basically have, I think, a decent business with ROEs at 20%, which to me says it's a decent business. Most dealers' profits come from finance, service, and aftermarket sales. They're vertically integrated into these various sort of segments, including used cars. The used car sales are lower, but they're financed with the floor plan. The floor plan financing is very interesting because it basically, when you look at these dealerships, you need to break out floor plan and non-floor plan, because floor plan financing is basically financing provided either by a bank or the OEM itself at a low interest rate that's financing their inventory. So the inventory, let's say, for example, Asbury has their inventory turns are 5 times. So they're turning these things pretty quick. And so in essence, if it's 5 times, then in essence, the loans are pretty secured from that perspective. And then the other aspect of the business, you have a consolidating in a fragmented market. Another way to take a look at this is a segment by quality and price. You've got premium and mass market. Asbury is more towards the premium segment, where people are willing to pay more for service than, let's say, in more of the mass market segment, where you're probably going to see more people from where the internet guys may have an advantage because the focus is more on price versus service that someone's willing to pay. So if we take a look at sort of growth historically for the business, they've had really good growth. They've gone around, 20 in the 20% range in both 5 or 10 years when you get down to EPS, but you can see the revenue is growing 7 to 8%. The EBITDA is higher and the EPS is higher. This is showing the operational leverage in the business. If the business had no operational leverage, you'd see the EPS growth be similar to the revenue growth and similar to the EBITDA growth. But you can see, based upon these numbers alone, if you look at it, you'll see the same sort of thing happening there. The interesting thing about Asbury is they have a capital allocation committee as part of the board, something that's very unusual that I haven't seen before, which I think makes a lot of sense and really sort of differentiates them. If we take a look at the current returns, their debt's yielding around 4%. The stock trades at 8.6 times. You add together growth plus earnings year, you're getting a 25% return. As a relatively high, one way to sort of look at business is take a look at what's the debt versus the equity yields. We have a pretty good high spread here of roughly 6%. And if you exclude the floor planning financing, you're talking about 9 times EV to EBITDA. And when the key challenges here is the changing service needs, which we're seeing what's happening in Europe and in Billy, Scandinavia in particular, to sort of see how that's rolling out, but it seems to be maintaining itself. And I say is Billy is at the front of this transition and it's still generating a decent return on equity. So I think the business going forward, at least from what we can see now, is not going to go into some kind of catastrophic decline because EVs have changed the market. And so the next thing we look at is sort of management incentives here. Management owns, a small percentage overall, but they do have decent equity ownership levels. The CEO has to have 5 times the salary, other management 3 times. These are the incentives. You see what they're focused in metrics on. This is good to sort of see what their goals are. They're looking at EPS growth, operating margin, same store parts sales growth, GP growth, gross profit, same source used sales growth. And then, so what they do is they have sort of a matrix where the equity incentives are 60% performance based upon these metrics, and then they overlay it on relative shareholder total return versus other dealerships. Right now, they're granting around 1.1% of equity granted per year, which is saying that you're not getting diluted as a shareholder of Asbury. Here's the forward-looking valuation, as we had said before. If you look at the numbers today, the time was 175. Right now, it's selling for around 7.9 times earnings. If we project it forward 5 years, we're getting 3.4 times earnings, which, given sort of the growth profile we hear, just doesn't make any sense. And so there's some really nice potential upside on here. I've sort of used a simple model where you can use what's called a Graham formula. What should be the theoretical PE of a company that's going to grow 10%, their earnings 10% over the next 7 years? I get roughly around 30 on that. And so if you apply that to the current price, the IRRs are pretty significant here. And again, the revenue growth, as we talked about before, is same store sales, M&A growth, and internet growth. You look at their competitor, Lithia, they have higher numbers. And so I mean, I think given sort of their model historically, this is definitely realistic projections. In terms of operational leverage, their margins has tripled with the revenue growth, again, because they're focused on the clustering aspect. You don't see it as much in the other dealers' sort of operational leverage because they're not quite as clustered. There's a local economies of scale. And again, sort of if you look at the other competitor that's following a similar strategy, they're doing a similar type of, they're actually have a higher growth rate, or the growth rate's roughly similar. Ours is roughly 30, and theirs is 34. And then these are just to give a rough idea of sort of where the valuations are falling today, and some of the other companies. Now, there's a very interesting company, there's China Mindong, which is basically a company in China that probably has the highest inventory turn. You see it 35 times. And one way to think about inventory turns in this business is how fast can you match people to cars? Because the focus of the business, if you think about velocity in a car dealership, the quicker a person can match a customer to a car, then they can go to the next person, customer and car. The quicker you can do that with a good customer experience, the better it is for everybody, right? And so that's, in my mind, that's one of the key operational metrics you can measure here. And so this company in China just has just blown the doors off this. And if you read they actually have annual reports in English. If you read their reports, you can sort of see that the guy has a really good approach to customer service. And they've just done a really good job. I mean, they're focusing on luxury automobiles in markets in China where they're the only player, and they get very high turns. Like I'm saying, it's a really nice model. And MotorPoint is sort of like a car. Well, CarMax focuses on slightly used cars in the UK. And again, they have the high turns in their model also of roughly 5 times in billion. You can see the rest of them here, but in essence, that these are just some other interesting international comps that folks are interested in looking at those. And so in conclusion, right now, the company basically is selling at, I think, a significant discount to what its normalized earnings should be. One of the things that is, you need to sort of segment out here, is given the fact that we've had the part shortages in some of these dealers, is trying to segment out the cyclical versus the non-cyclical part. This business over time has sort of grown nicely, but there is some cyclical aspect in the fact that when you do have shortages, as the shortages come down, the margin should come down on that, but the volume should be able to, sort of offset some of that, and how that's really happening. And you see that in a lot of businesses where basically, especially in the retail markets, where it's really unsure of, okay, is this COVID induced, not necessarily COVID induced, but maybe a side effect of COVID in terms of shortages, and how is this all going to play through the system? I think given the low multiples that Asbury is trading at, you have a lot of margin of safety. If those things even go the wrong way, you're still going to be fine. And so I think that's the way I sort of look at Asbury as a business, is saying, okay, I can't specifically quantify, okay, what this specific, COVID versus non-COVID and shortage effect's going to be, but I've got a huge margin of safety just given the multiples that I'm paying at, and then also the underlying growth engine that's happening here, which historically has done well, and I expect it to continue to do well over the next 4 to 5 years. And so I think that's sort of the combination of and so that's an example of sort of a consolidation, and where we've been able to find an interesting company that's growing at really nice rates in a market that overall is probably not growing a lot. The overall, car retail sales market is probably growing at GDP or maybe even less, but these companies have really interesting growth prospects. So that's the pitch for consolidation and Asbury Automotive.
Excellent. Thank you so much for that presentation. It's really great. And so our first question is, how did you initially become interested in investing, and also in value investing in particular?
Well, I originally became interested in investing probably when I was in college. This was a while back. I was getting an undergrad degree in engineering, and went to Union College in Schenectady, New York. I spent a summer at Cornell University developing an integrated circuit. It was an electrical engineering degree. And then during that time, I was able to dive into some of the value investing classics. I took a few classes in college, but when I joined college, one of the things I had done was I was part of the Air Force ROTC program. This was a time when the Cold War was really going. And so I decided, okay, why don't I just serve my country in terms of being a part of the Air Force early on. So when I graduated, I was an Air Force officer out in Los Angeles, and we built a space system that was supposed to live through nuclear conflicts and stuff like that. So it was a very interesting time. I mean, I think my interest in investing was primarily just because it's just something I've always enjoyed. I enjoy doing that. I worked as an engineer for a number of years, then started working as a business appraiser. And business appraiser, we're doing the same thing that public investors do, but we're doing with private businesses. And so we get a lot more sort of inside information in terms of insights into these businesses. And so I've used a lot of the frameworks that we use to value businesses in the private market to basically value businesses in the public market and take a look at sort of what's going on there from an industry perspective. And sort of I think my overall approach initially was focused on sort of more of deep value type of stuff, but over time, what's really important, I think, is growth, and incorporating growth into a deep value type of an approach, I think, is sort of, now initially you can start out by doing it with screens, but the issue with screens is what I've observed recently is most of the companies that are cheap on a screen, they're cheap for a reason. And you look into it and you say, okay, but a lot of times I think what I think's an interesting way to do this for folks who are interested in getting involved is find an industry that you're really interested in. And then take a look and start out, say, okay, like for example, let's say you like cable companies. Okay, we'll start out looking at Charter. Take a look at all their competitors and just sort of get an idea of what are some of the key parameters for those companies. And then over time, as you develop this library of knowledge that you've developed for that particular industry, maybe it's applicable in another industry. And that's where I think the real interesting aspect of it comes in, is that a lot of these themes, like we're talking about consolidation, operational leverage, you see in one industry may be applicable in another industry. And so that's what I've sort of been excited in my career as a business appraiser. I mean, it's more of a generalist type of thing, looking at a lot of different companies, but in essence, I think it's the same set of analysis tools that you're using, just for a different purpose.
Yeah, I think that makes a lot of sense. And also, so overall, compared to in the past, do you believe that it is getting easier for companies to maintain their moats as a result of global scale, or harder for companies to maintain their moats because of the rapid pace of technological change?
Well, what I think what's happened is it's right now we're sort of, I would say, in a transition time. Usually so if you go back into, let's say, if you look at like the industrial revolution, what happened there was you had a lot of companies that built up great moats, companies like Standard Oil, US Steel, those types of companies that built up great moats at that time, right? What happened over time is technology has come in, overseas competitors have come in, and so the moat's been eroded over time. And that's what we're sort of in a period of time now where I think we've had a lot of change for the internet, right? You had in 2000, you had a lot of infrastructure built in. A lot of the companies went bankrupt, but the infrastructure was still there, and the people built on top of the infrastructure. You had Facebook and Google. These companies built on top of the infrastructure. And so what we're really seeing is, and so they got great market share. But what I think is going to happen over time is people will find ways to compete against these types of businesses, right? I mean, I think that probably the one that has the quickest life cycle you can see right now, I think, is Facebook, right? I mean, so Facebook, it went up and did really well, but now in its core business, it's running up against competition. And then now it's gone off and tried to do this additional sort of virtual reality meta kind of thing. And so I think you can really see this depending upon the cycle of the business. And some business cycles really, really quick. It's a book called The Innovator's Dilemma, which is a really good book that talks about, and they focus on the industries that are turning really quick, like semiconductor, mask technology. Those things can happen. There's things in the book they're talking about that could happen, 2 or 3 times a century. And when you see that very quickly, companies will build up like their whole supply chains around it, and then it'll be disrupted. And so you see that. So that's an example of something quick, but it's still applicable to even companies where it happens really slow. Like, for example, retail happens really slow. That happens over centuries, but companies still have set up value chains and have incentives to basically. So for example, if you look at like one time Kmart was basically taking business from the big department stores, and then they went to Kmart, and then now you've got the online stuff. So you have multiple generations. And what I find very interesting about these companies is the old companies don't go away. What really happens is the market gets further fragmented. So let's take a look. For example, we talked about auto dealerships. Okay, I don't think traditional auto dealerships are ever going to go away. It's just going to become more fragmented, and businesses are going to have to adjust and deal with that aspect of it, and being able to adjust and be adaptable to the changes in technology, and basically making it, being able to come up with a competitive product. And a lot of it's just competitive products and services. And in the end, I think the businesses that win are the ones that provide the best service, right? And they understand the customers and basically can provide the best service to the customer. And if you can integrate the internet into that, that makes the transaction easier. And some people are going to feel 100% comfortable with an internet only solution. Primarily, I think younger folks are used to growing up in a digital world. A lot of folks aren't, but I think I think the key to success in a lot of business, though, is customer service, either it being done over online or in person, or some combination of the two to basically provide service to customers.
Yeah, absolutely. I think that makes a lot of sense. And maybe speak a little bit about, how does one know when is the right time to start maybe their own fund or their own sort of financial services company, and how do you raise that initial capital?
So yeah, I mean, I think a lot of it really depends upon, I mean, the specific story about Bonhoeffer is I sort of did investing on my own as an independent investor for probably about 10 or 15 years before that, and developed a track record. For people that are interested, that's probably something you want to do. And then in terms of, there was an institutional partner I work with that basically provides a lot of the back office support. That's Willow Oak. And that really allowed me to just focus on just the investing aspect of it, and then talking with individual clients, as opposed to having to deal with a lot of the back office kind of stuff. And there's a lot of regulatory and compliance aspects of this business that you can spend a lot of time on. But for me, it was just like, okay, I'd much rather have someone else do that. And there's a number of ways you can do that. So I think in terms of starting a fund, what I would recommend folks to do is to develop a track record. First of all, I'm assuming someone who does this is going to be interested in doing this as sort of like their passion. So either you develop your own track record, or you go work for one of the fund companies that are hiring people and develop some expertise there. But a lot of it is just, okay, it's personality driven, and there's a lot of different ways to do this. And I know that the number of spots at investment management companies is somewhat limited, but there's other avenues where you can use the same skills and develop the same skill sets. Like what I did is basically go into business appraisal. It's a very large business. There's a very large demand for that. And that way, a lot of times you can make a decent amount of salary, save up and do this on the side or whatever. I mean, it really depends. I think the skill set is a very important skill set that's used in a lot of contexts. So it's used for asset management. The skill set's used for PE and private equity. It's used in business appraisal. And so there's a lot of ways if you've got that skill set. But I think the key thing to do is, if you want to get into the business, is building up the skill set and being able to. And the nice thing about the internet right now is and there's a number of guys that have done this. You sort of set up your own blog and say, okay, here's these things, here's sort of some investments I've done, and and basically just track it like that. And that provides a public example of your work. Another big thing that's changed over the past few years has been Twitter. I mean, Twitter is very interesting because you can get a real-time view of what people's thought processes are and how they think about things. And that's a very important aspect when it comes to investments, is trying to understand what's the thought process. And so for example, in our fund, what we end up doing is we like to provide a lot of details, case studies, and other aspects. So as an investor, I think in a fund like ours, you want the investors to understand what you're doing. You feel comfortable with, okay, this is the way I'd like to invest. And that's what the communication process is all about, is just saying, okay, like for example, this presentation we just did here, this has been explained in my quarterly letters probably over the past year or so as this process has evolved. But I think that's important to basically, because as an investor, you want to understand how the manager is investing your money. And in my mind, I think that's because part of this business is trying to find investors that are basically aligned with you, believe in what you're doing, and the money will most likely be sticky from that perspective. You don't want to have investors that are going to be pulling money, because that creates all kinds of issues. But I think part of it is basically is trying to grow a client base. Basically, part of it can be through writing or through other aspects of what you can do. But I think as an individual that's interested in getting this business, I think there's more now than there ever has been opportunities to sort of show your analytical capability. And what I'd recommend is just be open to where it ends up. I mean, you may like doing investment management, but if someone offers you a job as an appraiser or some other area, just go for it. And just, and you never know where you're going to end up. I mean, as long as you, in the job that you're doing, you're getting more skills and you find the work interesting, I think that becomes a win-win.
Yeah, absolutely. And how important do you think either a MBA or a CFA is in the investment management industry, and in particular in regards to value investing?
Well, I mean, I think, the way I look at those is, okay, I think they're important from a credentialing perspective, right? I mean, all that MBA and CFA is going to do, you're going to get your foot in the door. After you get your foot in the door, you're going to have to prove yourself that you've got some unique way of thinking or a different way of looking at it, or you've got, you'll understand value investing and you understand the details of it. I think it's important, especially an MBA is probably important if you're coming from a non-financial background into finance, because I got my MBA at UCLA, and it was important for me to basically, they wouldn't hire an engineer, which is what I previously was doing, to be a business appraiser, for example. So I think for people who are coming from fields that are non-finance, I think MBA is important. CFA, similar sort of thing is that, like, for example, in the company that I used to be a managing director for a valuation firm, we looked at CFA or MBA as being one of the key parameters of basically, one of the key credentials that we needed when we hired people. And so part of that is just basically being able to, in both cases, I think it really shows a certain level of interest, a certain level of, what you've done in the class and competence, and that'll probably come out in the interviews. I mean, if you can go into an interview, like, for example, for business appraisal, if you've done an MBA or CFA, you'll understand, you'll be able to describe, okay, how do you value a company? What's the DCF? What's a comp model? What are some of the details behind that? And how does that sort of pull out and compare to the real world? And how does that really how are the models you're putting together reflect reality? Those are the kinds of things that people are really looking for. And if you've got that mindset, sort of the systems mindset of thinking about things on a system level, then that's a real leg up, and no matter what you're doing. But I really look at those as, MBA, like saying, if you're changing careers, I recommend both of them because they're very good credentials. But I think what they're really good at is if you're trying to get into an investment management type of a position, because it may be a filtering criteria that some people may say, okay, I guess an easy way to say, okay, I'm going to filter out anyone that doesn't have an MBA or a CFA. But again, a lot of it comes down to your relationships. If you happen to know someone at a company and they say, okay, this guy doesn't have an MBA or CFA, but I know he loves this stuff and this is what he's done, that's probably going to carry a lot more weight than an MBA or CFA on a but I think the other aspect of this is just being around other types of investors. There's events you can go to where in essence there are a lot of these people around that you can just talk to and just have an interest in sort of investments. I mean, for example, go to the Berkshire Hathaway annual meeting is one. There's a Fairfax financial meeting up in Canada is another one. So another thing you can do if you're interested is just go to one of these meetings and just hang out with people. There's a lot of events that are there that are free or not that much cost, and just go and just hang out and just talk with people and develop a common interest and bond. And I think that can lead to a lot. I mean, at a minimum, you're going to hear someone else just talk about investment stuff, and you're probably going to learn something, and it could lead to a job, right? I mean, that's sort of the soft networking part of the business. I think that's important if people are interested in getting. It's just like for any job. If you're really interested in the job, you go out and you find people in the industry and just let them know you're interested, and then your name gets around, right? I mean, that's just sort of the way businesses work. So
Yeah, I think that makes a lot of sense. Maybe speak a little bit more about how you analyze management.
okay. Part of it is, seeing what have they done with the capital that's been returned to them. So you really need to take a look at the hand they've been dealt. So let's look at Asbury, for example. So Asbury was a traditional auto dealership. So what hand were they dealt? Well, the hand that they were dealt was they get a good amount of cash flow from the dealership, and then what are they going to do with the cash flow? So they've got a number of options. Okay, they could buy back stock, they could provide a dividend, or they could apply it to acquisitions when they found the price was right. And I think the one thing that's interesting about them is they've systematized this whole process so that they actually have a board committee that's focused on capital allocation, which is the only company I've seen in the US that does this. But to me, what that tells me is that they think of this as a critical role of the board. And this is something, setting the parameters correctly. So the key thing for management, in my mind, is, first of all, whatever business you've got, what are they doing with the capital? Especially in how are they allocating? That gives you some idea. The other thing you want to take a look at is, how is the pie being divided, right? But the key thing is, okay, take a look at what their capital allocation, and then how is the pie being divided? How is the pie being divided? For example, Asbury, they're giving 1.1% of the options away per year. I think that's a very modest amount. You get other companies that are giving very large amounts, and the real question is, okay, how much of the business are you really going to own, right? As a minority outside shareholder. And a lot of that probably really depends upon the business. If the business is really being driven by principles that are really bringing in the business, and there's not much outside of the value of the principles, then that probably makes sense. But the businesses you want to try and find are businesses where there's there's value being created outside of what the current management is doing. But I think the incentive, so those are the incentives. I mean, the other aspect of it is just take a look at, one thing I like to look at is what's the relative compensation of the people on the management team. That will tell you a lot. So if the CEO is making 30 times or 10 times, let's say, the next guy in the management team, that alone tells me something about, I don't even need to know who the guy is. To me, that's an ego thing, right? I mean, and so you're trying to find guys that like doing this as that's almost their mission, not because they're doing it because of the money. And you can see that in just the disclosures that are out there, I think. And the other thing that's a real difficult thing to do, where I've sort of had some challenges in the past, is dealing with situations where what's management's motivation, especially if they've got a big private equity investor that's a big part of the company. And I've had, over the past year, I think I've had 3 companies that have been taken under because management has gotten comfortable with either private equity or some other investor to try to take the company under. Now, those are more difficult to try to determine upfront, because it's not going to happen till it happens, and unless the management has a track record of doing that, if it does, then you need to make your own decision, and probably the appropriate thing to do if that happens is just don't size the position that big, because that they may take you under just from that perspective. But that's the kind of situation where you're just saying, okay, you did the analysis right, the market worked out right, but then somebody else came in and swooped in and got the profits that you would normally get. I mean, that's sort of a management. But then the other aspect of it is, how much are they really training the people down the line? So, for example, Constellation Software is a perfect example, I think, of a company that's designed to continue to grow. And in this consolidation game, they've basically come up with a really good system to basically create people that continues to do that down the line. And in my mind, I think that's a key aspect, given sort of where we saw, okay, you go to roll-ups to consolidation to accumulators. In their segment, they've developed a system to actually generate internal growth, which becomes sustainable over time. And it becomes almost like a snowball, right? And it just keeps on growing and growing. And you have new people, and you train new people, and you give them responsibility. And so those are the types of things you try to look for in these consolidators, in terms of ones that will probably have a sustainable management. If you look at over time, the one thing that's going to probably have the biggest impact on price over time is culture in these companies. And culture is set example from the top. And that's why it's important to look at management and what types of incentives do they have and what kind of attitudes do they have, because it's going to roll downhill. If you've got a manager that's making a lot of money and not only cares about his own self, then it's eventually it's going to show up in the company, even if it's a great business. So, but those again are things that you can try and get from public filings. You can try and talk to other people and see what other people's views are on it, but it's a qualitative part of this business where there's no quantitative answer, but it's a very important part of the business to really be able to assess correctly.
Yeah, absolutely. I think that makes a lot of sense. Could you present 2 case studies of past investments that you've made? One that was successful and your thesis played out, and one that was unsuccessful and your thesis did not play out, and what you learned from that example?
Sure. So, I mean, I think the first one, why don't I do the successful one at this point? It's still sort of playing out. It's in this consolidation field. We had mentioned it was Ashtead. So Ashtead is an equipment rental company in the U.S. The U.S. is a very unique market versus other markets around the world. There are 2 major players that are the largest players in the market, but there's a large market to consolidate. They've used similar things that we see in the car dealership space where there's local economies of scale. These guys rent equipment to construction equipment. They also rent scissors lifts and other types of equipment to various construction and other types of, they do some stuff for Hollywood and stuff like that too. The key thing behind that business is that the local economies of scale are just tremendous. And the one thing that you've got in that business is the more equipment you've got in a specific market to lease, the higher percentage utilization you can have. So if you're dominant in the market, you're going to have a wider selection. You can offer better prices, and you're basically going to be dominant. So basically themselves and a company called United Rentals are the dominant players in the US. I've liked Ashtead a little bit better because it's more organic growth. United Rentals has grown more through acquisitions. And they've done a great job. I mean, it's basically in a cyclical, it's interesting because if you look at the analysts that are following it, they're industrials analysts. But in essence, the way the company has grown, it's much more steady just from a perspective. If you look at their margins have increased by roughly 10% since the last peak. So you had a peak in 2007, 2008. You had a peak before coronavirus. Their margins have gone up roughly 10%, and they'll continue to do that as they continue to consolidate in the US. And so that was one that actually worked out. We've made a few 100% at this point. We're still holding it. I think it's an example of sort of the compounders we're talking about. I mean, we have a few of the other ones that are sort of in process, Asbury being one that's sort of we're hoping that plays out similar for that particular company. Now, ones that haven't worked out, the ones, those have been, the one in particular I can think of is one of these companies that was taken under recently. It was sort of in the car business also. We made a little bit of money, but we think the business was probably worth 2 to 3 times, double what the guy basically ended up paying for it. Same thing happened to a company called At Home earlier this year. And so I think those were the ones where, as we mentioned before, it's tough to know going in what is management going to do? Because you can talk with them, but you don't know where their real intentions are till the rubber hits the road. And there's not that many, when it comes down to a situation where you've got a private equity guy there saying, okay, we're going to provide you all these incentives if you let other shareholders, if you basically, if you sell us your company, and to a certain extent, we're going to take some of the value from the minority shareholders that are out in the market today, and we're going to provide you all these financial incentives to do that, and we're going to help you out a lot by doing all this stuff. What's management going to do, right? I mean, management may say, I think it's the rare management team that would be willing to turn that away and say, I really want to do stuff for minority shareholders. A number of them would say, okay, I want to take the deal because I can get a better deal this way. There's minority shareholders out there, and so I think that has been one of the lessons learned that I've had in this process. I mean, and as you're going through this, you learn lessons as time goes on, right? I mean, when you start out, I started out, one of the biggest mistakes I made before I started the fund was I invested in a cable company that eventually went bankrupt. So you start out, invested it, and I made as much money that I lost coming when it came out of bankruptcy, but you learn these things and you sort of try and find good models of ways to sort of prevent this particular thing from happening again. So for example, one of the things that I try and stay away from are heavily levered businesses in declining industries, or what's the right amount of leverage for a decent recurring revenue business. And you look at somebody like John Malone described in The Outsiders, and it gives you some idea of what the reasonable amount of leverage for people that have been successful in the business. Because if you under lever, you're not going to get the returns. If you over lever, you can blow up. So it's a question of balancing off the two. And so from that perspective, I think what you really want to do is, I think it's the real challenge of sort of the management aspect. I mean, that was a good question in terms of how do you evaluate management, because you can take a look with their former capital allocation percentages, what they've done in the past, but I think the most difficult thing is what would they do in the future. I've had cases where, and this was probably another one too, where again, we made a little bit of money, but it was nowhere near it, where a distressed investor we were talking to basically, because we had said, we went into them and we talked with them. We said, okay, one of the concerns we have is you're going to take this business under. They told us to our face, we're not going to take the business under. But what happened? 3 months later, they went ahead and did it. So, it's it's very, I think it's, from my experience, it's very rare to find a management team that will turn away financial incentives for the stake of the minority shareholder. It's a very rare skill, or rare trait to find people having. And if you can find a management team that does that in those kind of circumstances, and they're in a decent business, those are the people that you want to be in your company. Because I think those have been the biggest, I guess I would say, disappointments or things that were tough. And I had a hard time saying, okay, could I have known this before? No, I mean, you take people, when somebody says something, you take them at their word, right? And you don't have a lot of track record. You haven't gone back and done extensive research. And even if you did, how would you know how this guy's going to react, or this gal's going to react to this specific set of circumstances? You really don't. So you're making a judgment call. So I think those have been the areas that, I mean, I've learned the most. And I think what I've found in those kind of situations, you just need to size the position so that things don't go your way. You haven't lost a lot. But if you find one where, the management is aligned, then maybe you can feel more comfortable, taking a larger position in that particular company.
Yeah, absolutely. Thank you for sharing those case studies with us. I think they're really valuable to learn from. And for a concluding question, what have been the most influential events of your investing career?
I think primarily it's been, I wouldn't say that there's specific events, but it's just been the relationships that I've been able to develop over time, talking with other investors and getting feedback on sort of concepts I've had. I've got some people that I talk to on a regular basis that say, oh, and aren't afraid to say, okay, what you're saying is just a bunch of baloney, and here's why, and where's some issues here, and try to work through it, and being able to try to figure out the counter case. Because whenever you come up with an investment thesis, I think you really need to have someone that's honest, that can basically come up with a counter thesis. And that really will tell you how confident you are in your thesis, because you go back and you say, okay, here's the specific aspects of this thesis that are weak. And is there data out there to support that it's weak versus not? I mean, and especially if you're buying stocks, and I would say and where you're going to find most of the value investing things are in controversial stocks. You're not going to find value price stocks in consensus types of consensus securities. So you're primarily dealing in places where the reason why you're going to get a good return is because you're betting against the consensus, and being able to have somebody that can really articulate and help you work through that process of being able to think about your thing and put it into perspective. Because as you're working through this, a lot of times you're down here in the trees and the weeds working through all this stuff, but having someone else to stand back and say, okay, let's look at the bigger picture here. Here are these issues. Here's why this thing may not be true. Is it true? And then trying to collect the data and trying to figure out, okay, is this true? Because you're basically doing hypothesis testing when you're coming up with theses, whatever. So basically you're coming up with, you're trying to hypothesis test, and you're basically saying, okay, and trying to collect the data. And then as more data comes in and you see more things, then you change your conclusion. So it's sort of like a, Bayesian sort of probability sort of exercise where you're basically incorporating the new information and seeing whether it makes sense or not. And then you always want to be aware of, okay, you've got an initial bias. Am I going too far? Am I just carrying this thesis to something that may be too far, and basically stepping back and taking a look and questioning and basically trying to work through it. But I think that's part of the process and what really makes this whole business pretty exciting, in the fact that you're working through specific points and arguments from that perspective.
Yeah, absolutely. Thank you so much. This is a really terrific session, and I really appreciate you taking the time out of your busy schedule to speak with us today.
All right. Appreciate the invite. All right.
Great. Thanks so much. Bye-bye.
Bye-bye.